Do you want to learn how to grow your wealth without taking unnecessary risks? For over 70 years, The Intelligent Investor by Benjamin Graham has been the go-to guide for anyone serious about building long-term wealth. Even Warren Buffett calls it by far the best book on investing ever written. At its core, Graham's approach emphasizes the importance of thinking like a defensive investor, focusing on safety and steady growth instead of chasing speculative gains. The book introduces key concepts like the margin of safety, which is the idea of buying investments with a built-in cushion to protect against losses, and Mr. Market, a metaphor for the emotional ups and downs of the stock market, highlighting the importance of staying rational in the face of volatility. Additionally, Graham stresses the need for diversification to spread risk and avoid reckless speculation while ensuring that your investment strategy is tailored to your financial goals and risk tolerance. Today, we're breaking it down for you. In this video, we'll explore its key principles, like the importance of playing it safe, managing risks, and staying rational in the face of market chaos. Plus, I'll show you a real-life example of how you can apply these lessons right now. Stick with me because this isn't just about stocks. It's about making smarter financial decisions, no matter where you are in your journey. 1. The importance of being a defensive investor. Benjamin Graham emphasizes that successful investing is not about taking big risks to chase big rewards, but adopting a disciplined and patient approach. He categorizes investors into two types: defensive and enterprising. Defensive investors prioritize preserving their capital by avoiding high-risk investments and focusing on reliable options like index funds or blue-chip stocks. In contrast, enterprising investors are willing to conduct in-depth research and take calculated risks to achieve higher returns. However, Graham strongly recommends the defensive strategy for most people. This approach is easier to follow, less stressful, and provides more consistent results. Defensive investing focuses on minimizing losses and earning steady, predictable returns rather than attempting to outsmart the market. For example, if you are saving for retirement, instead of speculating on individual stocks that could either skyrocket or crash, you might choose to invest in a diversified index fund like the S&P 500. This strategy allows your portfolio to grow steadily over the years, sparing you the anxiety of monitoring daily market fluctuations. Such an approach not only protects your investments from significant losses, but also ensures consistent growth over the long term. This makes defensive investing particularly suitable for those who lack the time, expertise, or risk tolerance to explore more complex investment strategies. Graham's message is clear that you don't need to be a stock market expert to achieve financial success. A cautious, slow, and steady approach often leads to better outcomes than aggressive risk-taking. By focusing on reliable investments and maintaining discipline, you can avoid the pitfalls of emotional decision-making and market speculation. Defensive investing is not only a practical strategy, but also a sustainable one, especially for those with long-term financial goals. In the end, the goal is not to beat the market, but to secure consistent, stable returns that build wealth over time. 2. The concept of margin of safety. One of Benjamin Graham's most influential principles is the concept of the margin of safety, a strategy designed to protect investors from unexpected losses. The idea is simple. Always invest with a cushion by ensuring the price you pay for a stock is well below its intrinsic value. Intrinsic value refers to the true worth of a stock, determined by factors such as the company's earnings, assets, and overall financial health. By comparing the current stock price to its intrinsic value, you can determine whether there is a sufficient margin of safety. This margin acts as a buffer, reducing the likelihood of significant losses even if the company underperforms or market conditions deteriorate. For instance, imagine you have thoroughly researched a company and determined that its intrinsic value is $100 per share. However, the stock is currently selling for $70. The $30 difference between the stock's intrinsic value and its market price represents your margin of safety. By purchasing the stock at a discount, you create a cushion that can absorb potential setbacks, such as a temporary drop in earnings or economic downturns. Even if the company faces unforeseen challenges, your investment is less likely to lose value because you bought it at a price significantly below what the stock is truly worth. Graham stresses the importance of this principle because the future is inherently uncertain. Market conditions, business performance, and external factors can change unexpectedly. By prioritizing investments with a substantial margin of safety, you leave room for error, which is crucial in avoiding costly mistakes. This conservative approach minimizes risks and helps protect your capital, ensuring long-term financial stability. The margin of safety is a cornerstone of value investing and underscores Graham's philosophy of prioritizing risk management over chasing high returns. It reminds investors to remain disciplined, patient, and focused on long-term goals. In investing, as in life, it's always better to be prepared for the unexpected than to rely on predictions or luck. 3. Mr. Market, your emotional opponent. Now let's talk about one of the most memorable metaphors from the book, Mr. Market. Graham describes Mr. Market as an imaginary character representing the stock market's unpredictable and emotional nature. Each day, Mr. Market approaches you, offering to buy or sell stocks at prices influenced by his ever-changing moods. Some days he's overly optimistic, offering inflated prices that make no sense. Other days he's consumed by pessimism and offers absurdly low prices. The key lesson Graham imparts is that your job as an intelligent investor is not to follow Mr. Market's mood swings, but to remain rational and make decisions based on the intrinsic value of your investments. Mr. Market's erratic behavior can create both risks and opportunities. For example, during a market downturn, Mr. Market might offer to buy your shares for $50 each, even though their intrinsic value is $100. A fearful or panicked investor might sell at this undervalued price to avoid further losses. However, a disciplined investor sees this situation differently. Rather than succumbing to emotion, they recognize this as a chance to buy more shares at a significant discount. Similarly, when Mr. Market is overly optimistic and offers inflated prices, a wise investor resists the temptation to overpay for stocks, knowing that such prices are unlikely to reflect their true worth. The metaphor of Mr. Market highlights the importance of detachment and discipline in investing. Emotional reactions to market fluctuations can lead to impulsive decisions, such as panic selling during downturns or over-enthusiastic buying during rallies. Instead, Graham advises investors to use these fluctuations to their advantage by staying focused on long-term goals and intrinsic value. The takeaway is simple. Don't let emotions dictate your investment decisions. Mr. Market's offers are just that, offers. You are not obligated to act on them. By maintaining a rational approach, you can turn market volatility into an opportunity, avoiding costly mistakes and building wealth over time. Graham's lesson is a timeless reminder to remain calm and grounded, regardless of market conditions. 4. Avoid speculation and focus on investing. Benjamin Graham draws a firm line between investing and speculating, stressing that the two are fundamentally different. Investing focuses on long-term growth, supported by careful analysis of a company's fundamentals, such as its financial health, competitive position, and future prospects. Speculating, on the other hand, is akin to gambling, where decisions are based on short-term market movements, rumors, or trends rather than sound reasoning. Graham warns against treating the stock market like a casino, as speculation often leads to emotional decisions and significant losses. A practical way to differentiate between investing and speculating is to ask yourself a simple question before purchasing any stock. Am I buying this because I believe in the company's long-term potential, or am I hoping to make a quick profit? If your answer leans toward the latter, it's a sign to reconsider. Speculative behavior often stems from a desire for fast gains, but it lacks the foundation of stability and analysis that true investing provides. The dot-com bubble of the early 2000s serves as a stark example of the dangers of speculation. During this period, many investors poured money into internet companies with no real earnings or business models, driven by hype in the hope of rapid profits. When the bubble inevitably burst, billions of dollars were wiped out, leaving speculative investors with massive losses. Conversely, those who invested in solid, established companies with proven track records managed to weather the market downturn and emerge stronger in the long run. The key takeaway is to avoid get-rich-quick schemes and focus on investments that offer real value. While speculation may seem exciting, it is fraught with risk and uncertainty. True investing requires patience, discipline, and a commitment to understanding the long-term potential of your investments. By avoiding speculative behavior and concentrating on sound investment principles, you can build a portfolio that not only grows steadily, but also withstands the ups and downs of market cycles. 5. The power of diversification. Benjamin Graham highlights the importance of diversification as a fundamental principle of investing. Diversification means spreading your investments across different stocks, industries, and asset classes to reduce risk. No matter how confident you may be in a particular stock or sector, concentrating your investments in one area exposes your portfolio to significant potential losses. Diversification acts as a safeguard, balancing risks and rewards to provide more stable returns over time. The logic behind diversification is simple. Not all investments perform well at the same time. Economic cycles, industry trends, and unforeseen events can impact different sectors differently. By diversifying, you ensure that even if one part of your portfolio suffers, others may perform well enough to offset those losses. This strategy protects your overall investment and helps maintain steady growth, even in uncertain market conditions. Consider an example. Imagine you invest all your savings in a single tech company. While the company might show promising growth initially, an unexpected scandal, regulatory issues, or financial troubles could cause its stock price to plummet, potentially wiping out your entire portfolio. However, if you diversify your investments across multiple industries, such as healthcare, energy, consumer goods, and technology, any losses in the tech sector could be balanced by gains or stability in other areas. Diversification doesn't mean blindly spreading your money across random stocks. Instead, it involves carefully selecting a mix of investments that complement each other, reducing overall portfolio risk. This can include a combination of stocks, bonds, mutual funds, and index funds spread across different sectors and geographies. The key takeaway is clear. No matter how promising an investment may seem, avoid putting all your eggs in one basket. Diversification is a practical way to minimize risk and protect your portfolio from the unpredictability of the market. By spreading your investments wisely, you create a stable foundation for long-term financial growth while reducing the impact of individual setbacks. 6. Know yourself and your goals. Finally, Benjamin Graham stresses the importance of self-awareness in investing. Understanding your financial goals, risk tolerance, and time horizon is essential to creating an investment strategy that works for you. Are you saving for retirement, buying a home, or building wealth for your children's future? Each objective requires a different approach. Knowing yourself and your goals allows you to align your investment strategy with your unique circumstances, ensuring that your decisions are both practical and effective. Your risk tolerance plays a significant role in shaping your investment choices. If you're risk-averse, you may prefer safer, more stable options, such as bonds or index funds, which provide consistent returns with minimal volatility. On the other hand, if you have a higher tolerance for risk and a longer time horizon, you might consider individual stocks or growth funds that have the potential for higher returns, albeit with greater risk. For instance, a 25-year-old saving for retirement over a 40-year period can afford to take on more risk. They might invest in growth stocks or equity funds, focusing on long-term gains. The extended time horizon allows them to ride out market fluctuations and benefit from compound growth. Conversely, a 60-year-old approaching retirement would have a much lower risk tolerance. Their priority would be preserving capital and ensuring steady income, so they would lean towards bonds, dividend-paying stocks, or other low-risk investments. Graham's principle acknowledges that there's no universal formula for investing success. What works for one person might not suit another. By tailoring your investment strategy to your specific goals and circumstances, you can make informed decisions that maximize your chances of achieving financial security. The takeaway is simple. Investing is personal. Take the time to assess your goals, understand your comfort level with risk, and plan accordingly. A well-aligned strategy not only boosts your confidence as an investor, but also increases your chances of long-term success. Real-life example. Applying these lessons. Let's consider a real-life example of applying Benjamin Graham's investment principles. Sarah, a 30-year-old investor with $10,000 to start, decides to build a portfolio for her future using Graham's strategies. First, she adopts a defensive investment approach to prioritize stability and long-term growth. She allocates 70% of her capital to a low-cost index fund, which offers diversification and steady returns, and the remaining 30% to high-grade bonds for added security. Sarah also applies the margin of safety principle when researching individual stocks. She evaluates companies based on their intrinsic value, ensuring she only invests in stocks priced significantly below their true worth. This approach provides her with a buffer against unexpected losses and helps her make rational decisions. When the market experiences a dip, Sarah remains composed, ignoring the noise and emotional fluctuations of Mr. Market. Instead of panicking and selling her investments at a loss, she stays committed to her regular contributions, viewing the downturn as an opportunity to buy more at lower prices. This disciplined behavior reflects her focus on long-term goals rather than short-term market movements. Sarah also takes diversification seriously, spreading her investments across various sectors, including technology, healthcare, utilities, and consumer goods. This balanced portfolio reduces her exposure to sector-specific risks while maintaining the potential for growth. Additionally, the bond allocation in her portfolio provides stability during periods of market volatility. Over the next decade, Sarah's portfolio grows steadily thanks to her disciplined and thoughtful approach. She benefits from the power of compounding and feels confident in her financial future, knowing that her investments align with her goals and risk tolerance. By following Graham's principles, choosing a defensive strategy, using the margin of safety, ignoring market noise, and diversifying, Sarah demonstrates how these timeless lessons can help everyday investors achieve long-term success without unnecessary stress or speculation. And there you have it, some of the most powerful lessons from The Intelligent Investor by Benjamin Graham. To recap, adopt a defensive, disciplined approach. Always invest with a margin of safety. Ignore market emotions and focus on value. Avoid speculation and diversify your portfolio. Align your strategy with your goals. The principles in this book may not make you rich overnight, but they'll help you build wealth steadily and wisely. If you found this video helpful, hit that like button and subscribe for more actionable content like this. Don't forget to share this video with your friends who are interested in investing. And here's your call to action. Comment below and let us know which book you'd like us to cover next. Thanks for watching, and we'll see you in the next one.